What's up, future Filipino CPAs? Welcome. If you're deep in your LECP review and past 20 on government grants is making your head spin, don't worry, you are in the perfect spot. Today, we're going to break this topic down, make it super simple, and help you lock in that knowledge so you're ready for the big day.
All right, let's just jump right into the deep end with a classic LECPA-style problem. This is the kind of question that really tests your understanding. Now, don't panic. You don't have to solve it right this second. We're going to build up to it piece by piece and then circle back and crush this problem at the end.
So before we can even think about tackling that challenge, we have to start with the basics. And you know what? The great thing about PS20 is that it really all boils down to one single, super important idea. Let's call it the golden rule.
First off, let's get the official definition out of the way. What even is a government grant? Well, the standard says it's help from the government, usually a transfer of resources like cash or land. But here's the key part. It's not a free-for-all. It's given in return for compliance with certain conditions. Basically, it's not free money, guys. There are always strings attached.
Okay, if you only remember one thing from today, this is it. Seriously, this is the golden rule of government grants. You have to match the grant income with the costs it's supposed to cover. So if you get a grant for a building that lasts 10 years, you recognize that income over those same 10 years right alongside the yearly depreciation expense. It's all about that matching principle. Get this, and you're already halfway there. Okay, so let's say the government gives you cash to buy a big asset, like that building from our problem. Well, PS20 actually gives you a choice. It's kind of like a choose-your-own-adventure for accountants. There are two totally acceptable ways to account for it, and yep, you guessed it, you need to know both for the boards. So here are your two options, side by side. Path A is the deferred income method. Here, you treat the grant like a liability, and slowly, year by year, you move it into your income. Path B is the deduction from asset method, where you just subtract the grant from the asset's cost right away. Now, the crazy thing is, both methods give you the same total profit over the asset's life. But, and this is a big but, they make your financial statements look very different. Using the deduction method makes your asset base smaller, which could make your return on assets look way better. That's a classic exam-level insight right there.
All right, now for the drama. This is the plot twist. And it's a favorite topic for exam questions. What happens when things go wrong, the company doesn't meet the conditions, and the government says, hey, we want our money back?
Listen up. Screenshot this slide, write it down, tattoo it on your brain, whatever you need to do. This is your #1 study hack for this topic. Repaying a government grant is treated as a change in accounting estimate. It is absolutely not a prior period error. What does that mean? It means you deal with the hit in the current year. You do not go back and change your old financial statements. This is a game-changing distinction. So when you see a repayment problem on the exam, don't panic. Just follow this 4-step game plan. First, figure out which of the two paths they took. Second, get rid of any grant balance that's still on the books. Third, and this is important, calculate any catch-up expense. And finally, recognize the whole impact in your current profit or loss. We're going to use this exact checklist to solve our problem in just a bit.
Okay, just a quick detour before we solve the big problem. Remember, government help doesn't always come in a big bag of cash. They can get pretty creative, and you need to be ready to account for these other forms of assistance too.
For example, the government might just give you a plot of land. If they do, you record it at its fair value. Or you might get a forgivable loan, which is basically a grant in disguise, as long as you meet the conditions for forgiveness. The key here is substance over form. You always have to look at the transaction and ask, what is the real economic benefit here? That benefit, that's your grant.
All right, deep breaths, everyone. The moment of truth has arrived. Let's go back to that monster problem from the beginning and use everything we've learned to solve it. To recap, P5 million grant, P12 million building, repaid after 2 years. Let's do this. Okay, let's assume the company used the deferred income method. The grant was P5 million over 10 years, so that's P500,000 of income per year. After 2 years, they've recognized P1 million in total. Simple, right? That means they still have a P4 million liability called deferred income on their books. Now they have to repay the full P5 million. First, you wipe out that P4 million liability. Boom, gone. But wait, they still have to pay another P1 million. Where does that come from? That, my friends, is a direct hit to the income statement. It's a P1 million loss for the current year.
Now, what if they use the other method, the deduction from asset? The thinking is totally different, but watch this. They initially recorded the building at P7 million, right?
the P12 million cost minus the P5 million grant. That means their depreciation expense was way too low for 2 years. Now that the grant has to be repaid, they have to fix this. They need to recognize all the depreciation they should have recorded from the start. We call this catch-up depreciation. And when you run the numbers, guess what it comes out to? Exactly P1 million. It's the same exact hit to profit or loss. How cool is that? Whew! We covered a ton of ground. To make sure all this information gets locked in your brain for the long haul, let's do a quick rapid-fire review of the absolute must-know points for exam day. Here it is, your PAS 20 LECPA cheat sheet. Number 1, the golden rule. Match income to costs, always. Number 2, the 2 paths for assets, deferred income or deduction from asset. You gotta know them both. Number 3, repayment. Say it with me, it's a change in accounting estimate. So critical. And finally, don't forget the other forms of help, like special loans and non-monetary grants. If you can master these 5 points, you'll be in fantastic shape for any government grant question they throw at you. So I'll leave you with this final thought to chew on. Now that you know both methods are perfectly legal and acceptable, which one do you think is better? Which one paints a truer picture of a company's financial health? Showing the asset's full cost with a liability on the side, or showing the net amount the company is really on the hook for? There isn't a single right answer here, but thinking through questions like this, that's what separates just memorizing rules from truly understanding accounting. Keep that critical thinking sharp. It's your best weapon for the boards. You've got this. I'll see you in the next one.